Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Monday, the 31st of March, Bull versus Bear webinar. Steve Mighty here on the Call for Trade Day. We'll go for our usual regular run through for Monday, which is a slight twist on our normal daily webinars where we take a little look at the shape of the week. We'll take a look back what we've had, what we've got, what are the major macroeconomic, geopolitical, fundamental, central bank events that are shaping markets right here, right now, and take a look at what's coming up in the week ahead to give us an idea of where the potential volatility points might come in the week, how we might adjust our trading strategies depending on where that volatility might lie. So we'll run through that, and then we'll also take a look at articles from the major news wires reflecting all of those fundamentals, and then also then dip into some charts. So we'll kick off in here. We're looking at our regular weekly macro matters that we put up in our macro summary. So these two documents in here, these two reports, if you're watching in the members area, underneath where you're watching now, there's three columns. Left-hand column, our daily technical analysis reports, which we'll look at shortly. The middle column, the fundamental reports that go out over the weekend, usually on a Sunday, and which we're looking at now, the macro matters and the macro summary. And then on the right-hand column, the news reports from our partners, scrolling daily news reports from our partners at LiveSquawk. So, these come from that middle column. So let's have a look. So equities were down again last week. 1.53% on the S&P, down just under 1%. NASDAQ just under 2.6%. Dow in here. I did the Dow, and the Russell down 1.6% in here. So significant losses. Having started the week on a more positive note, with some hopes that the Trump administration might soften its tariff approach, and then we got the opposite of that through the middle of the week, where Trump announced a new tariff, 25% on all auto and auto part imports, increasing trade tensions, increasing trade concerns, increasing inflation concerns, which saw US and global stock indices significantly lower. Incidentally, it keeps European stocks continue to outperform their US counterparts. Year to date, a 14% return on European stocks, positive, with a 3% decline in the S&P 500. So a 17% net outperformance by European stocks because of the tariff situation, and potential growth in Europe because of increased, or European stocks anyway, defense stocks, potentially infrastructure stocks, with a pivot towards maybe building out that European defense and infrastructure. So all of that in here. But anyway, markets lower last week and lower again this morning, incidentally. And it's primarily due with tariffs and the uncertainty. It's not that we've just got tariffs. Here's your tariffs, 20% done. It's there might be more tariffs. There might be on some countries. There may be not on countries. There might be on some industries. And that uncertainty, that confusion, which is hallmarking this Trump administration and was reflected and was hallmarked in the last administration, was it's keeping markets volatile. It's exactly what we saw in the last Trump administration. If you were around trading then, I'm certainly around through all of that. And markets are jumpy and choppy and indecisive. We get big moves down and big moves back up again as tariffs are put on, tariffs are not put on, tariffs are taken off. So we're going to have to keep monitoring this, but this is likely to continue for the next 3+ years, nearly 4 years at least. What else do we have in here? So tariff uncertainty continuing to drive markets in here, and it's having a knock-on effect into the data points. So we saw the PCE data on Friday, personal consumption and expenditure data. That is the Fed's preferred gauge of inflation, stubbornly high, ticking higher than expected. Concerns that inflation is not only sticking but is ticking back up again, and tariffs are only going to increase inflation expectations and potentially push that higher. And then we had two measures of consumer confidence last week. The Conference Board consumer confidence fell for a fourth straight month. And the University of Michigan consumer sentiment data in here, 12% decline, with inflation expectation for next year rising to 5%, the highest since 2022. So really negative coming out from the consumer. The consumer's pessimistic. Inflation is sticky. And then the concerns are this is going to start hitting into the labour market and hitting into growth data and business data. So with that in mind, we do have the labour market statistics this week. The US employment report is out on Friday, and that's going to be key for us to watch. We also have going into this week on where are we in here? The global manufacturing PMI on Tuesday, and then the global composite and services PMI data on Thursday. So Tuesday and Thursday we get PMI data, and then we get the precursor to the employment report on Wednesday from the US ADP employment change, and also US factory orders. And then those US and the Canadian employment reports both out on Friday. So although it's a quiet today, Chinese PMI today, German CPI retail sales, nothing really of note from the US. It gets really busy from tomorrow. So as I say in here, Tuesday, we get global manufacturing PMI, US ADP employment change of factory orders Wednesday, global composite and service PMI data on Thursday, US employment report on Friday. So a busy week ahead. What else? And then don't forget, if you want to see a summary of that, you can just go here. The macros. You might want to keep this open all week. Actually, in the macro summary that was also published below where you're watching. So the macro matters if you want to go in there, a much deeper look, and then the macro summary, the summary. One other thing I wanted to mention, so nothing really today near German retail sales. CPI data not out yet, 24 minutes, that CPI data out of Germany. We will want to monitor that. We do get Chicago PMI at 9:45. It's not a big piece of data usually. They've got three bulls in here. Doesn't you really usually move markets, particularly with the other PMI data we have coming out. And then the PMI starts coming out of Asia later tonight, and also get the RBA. But RBA, the Reserve Bank of Australia, not really impacting on the markets you guys are watching. Just a heads up, this is further out though, but we're coming up to earnings season. Not this week, next week. So next Friday, it really kicks in earnest. So over a week away yet, Friday the 11th of April, but it kicks in with the financials next Friday. We'll talk about that next week. This hasn't refreshed. I haven't been able to see the, let me see if it's refreshed in here. The, where are we? No, that's not the one I wanted. Sorry, wrong one. Let me just go and get the. Bear with me, guys. See if we can get the morning briefing. Looks like it might be here. Yeah, here we go. It's up there. So, stock set for another bad session as Liberation Day nears. So another rocky day for stocks. Stocks down already. Already in here this morning. A really bad day on Friday, and then again in here lower this morning. Donald Trump's plans for fresh tariffs coming on Wednesday. So this is Liberation Day, he's calling it. Strategist Goldman Sachs cut their S&P 500 target for a second time this month, citing a higher recession risk. Gold is continuing higher. The president plans to start his reciprocal push with all countries, tamping down speculation. He might limit the scope. So this Liberation Day, as Trump is calling it, will Trump's Liberation Day start a trade door? So that's coming Wednesday. So we're going to be keeping an eye on that and what news we get from that. So this is why the markets are in such in distress at the moment, why they're selling off, why they sold off heavily on Friday, and concerns it's all going to start coming through in the data as we go forward in here. And look, will Trump's Liberation start a trade war? Well, we may have already been in that trade war now. US stock futures tumble as tariff fuel recession woes. Stocks extend losses with deepening tariff fears. It's all the same stuff. Trump's reciprocal tariff set to start with all countries, so more aggressive than potentially anticipated. Make Europe great again. Trades are gaining traction. That's what I was talking about earlier on. 17% outperformance by European stocks since the beginning of the year, and gold surging to yet another new record high as a safe haven. Stocks fall sharply. Bonds and gold, boy. So bonds have surged higher since about the middle of last week again. After the tariffs on the autos and ongoing concerns about more tariffs, and this Liberation Day of further tariffs coming coming this week, sending bonds higher in price, lower in yields. Bonds going up as a safe haven. Buying bonds, extra demand for bonds, bond prices go higher, which pushes yields lower with that inverse relationship between bond prices and bond yields. So if we look around the world in here, everything's getting it. Big hit on Nikkei, 4% down. Hang Seng down 1.3%. European stocks, German DAX down over 2%. French CAC nearly 2% in here. UK FTSE down 1.3% this morning. And if we go and look at US futures, having had a really bad day on Friday, down the S&P down a further 1% this morning, and the Nasdaq 1.47% in here. Before we carry on with the indices, let me just turn to the bond markets in here. I'm really interested in the CME FedWatch tool. Oh, freezing here. 1 second. So this was basically at zero. This was basically 100% for unchanged in May. Look how this is creeping up. 18% chance now we may get a cut in May now, being started to be priced in. And if we go to June, remember it was between June and July for the first rate cut. Well, now only a 16% chance that we don't get a rate cut in June. So now the market pricing in 84% chance that we get a rate cut now in June. And interestingly, by July now, look at this. So now if we add these two together, this is one rate cut, the 34.2% column. This is unchanged by July. So 34.2 and 5.6 in here, we've got basically 40% here. Okay, so 60% chance we get one or more rate cuts. So this is pricing in 2 rate cuts or a 50 basis point. Maybe the Fed goes big. So by July, we're already pricing in 50 basis points of rate cuts. And if we go to December now, if you remember, it was caught between 2 and 3. Well, 2 and 3 of these two columns in here, the 33.8% column and the 19.1% column. We're no longer pricing in between 2 and 3. We're pricing in more between 3 and 4 rate cuts. So the market in the last week, since the 25% on autos, since the liberation days on the horizon, and it looks like tariffs going on everywhere. Then what we're seeing in here on this, that's on Wednesday, right? Wednesday, right? Yeah, Wednesday. Now the market pricing in further, at least one further rate cut this year, potentially more. That shift's happening in three or four sessions. And look at this. So this was then the end of last week, Thursday through Friday. Big push lower in yields, a plunge lower for the 10-year yields. And if you go and look at our charts, we've gone negative on the 30-year because we'd formed this topping pattern. But the surge back higher. Now we're flipping back to bullish in here. And right the way across the board, 10 years, look, bullish move. This is buying bonds. Bonds going up. Why bonds are going up in price? As a safe haven, like gold is going up. Bonds are seen as a safe haven, particularly US Treasuries, AAA rated security. So safe haven, pile into bonds when things are uncertain, when you're concerned, and equities selling off. So let's move out of equities, sell equities, buy bonds, and that's what we're seeing. Equities plunging lower, making new lows in here this morning, and bonds going higher since last week and again this morning. So higher prices, lower yields, 5 years and 2 years as well. Higher prices, lower yields. And if we go and take a look at the equities in here, this plunge back lower, we had turned slightly positive in here, but we're back to bearish now since Friday's price action. And we're obviously lower this morning, down through the recent lows for both the Nasdaq and the S&P. Big bearish days on Friday and then further lower. Gold making a new all-time high at the end of last week and again this morning. And oil in here continued to push back and higher in here. So oil is nudging higher despite the negativity around the global economy. And here we go. Nothing more to add. I don't think we don't even need to zoom in here. We're making new lows here on both that plunge lower on Friday, new lows below the previous low here that we established for the year back here in earlier in March, making new lows this morning on both the S&P and on the Nasdaq. We were close to on Friday anyway, and then making new lows, significantly lower already this morning. There's no reason to think we can't go lower. It's looking very negative going into today. Right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Market's looking very negative, even though no data coming out of real note from the US today. We do have data all week, but really watching out for anything on tariffs. And as long as we keep getting these escalation in tariffs, and if we get any kind of tit for tat, reciprocal tariff moves, we start entering trade war territory, and then likely stocks are going to remain under pressure. All right, guys, have a great trading day. Take care, stay safe. We'll be back with you with another bull versus bear webinar tomorrow. Bye.